All right, so thanks for hanging there with me last week. Sorry I had to cancel on Thursday. Hopefully we should be good for the rest of the semester now, since I'm have the natural immunity now, so we shouldn't have to cancel any more classes. So we were going to go over some papers on Thursday, so I'll do that instead today, so we get another look at some linear regression stuff. But before we do that, we'll kind of start off. I'm just using the slides from last week. So even though it says week 2, I think I might have updated them on Canvas, so it says like week 2 and 3. We'll kind of work through the rest of the slides from last week, and then probably I'll post up an additional kind of set of slides if we have time on Thursday, depending on how quickly we get through stuff today. We'll kind of have some new slides that I'll be posting tomorrow for Thursday's class. But for now, we'll work off of those from last week. We are talking about valuations, right? We're kind of taking a look at different leagues. And one thing that when we kind of took a look at some Excel data, I think we left off about right here, which we did already, I kind of alluded to this last time we met, which is that if we look across all the leagues, right, it looks like city size is kind of playing a role in terms of, the teams that are in the largest cities tend to have the highest valuations, right? Now, it's not all about population. We talked about it's not just city size, but also incomes. And right, we can kind of see if we look across leagues, potentially that, different leagues, right, there's more variation in the market size than others, right? So NHL tends to be kind of a little bit less variation in terms of the markets that they exist in, at least if we look at kind of Forbes valuation. We're not actually looking at revenue data here. This is going to be, Forbes is kind of combing through some of the revenue data and then putting a valuation on each team, right? So it's kind of where we left off. So we're going to kind of take a slightly different direction now. We want to be able to compare like the ticket market, and then eventually we'll introduce today the idea of kind of how do we understand the optimal number of wins for these teams. But before we do that, we do kind of do a little bit of review of market structure and kind of think about how would any type of non-perfectly competitive market for tickets, how would that kind of change things? We already said ticket market, we kind of have this vertical supply curve. So typically we think about, we start out with this perfect scenario where it's perfectly competitive, right? There's no one company, or in this case, no one team has any market power. So we say in that situation that any team or any company would be a price taker, right? If they're trying to set the ticket price, like they have to look at what everyone else is doing. And if they charge a higher ticket, they know everyone else is just going to go to the game where the tickets are cheaper. Now, obviously that's not how things play out, because each team kind of faces its own demand curve, right? There is overall demand for a sport, but each team, right, depending on its, how loyalty or its fan base is, how long it's probably been in the city that it's in, the size of the city, they're all going to face a slightly different demand curve, because going to a game of a team that they're not a fan of doesn't provide them as much benefit as a team that they are a fan of, right? So there is some market power, but we started out kind of assuming that there's no market power. Everyone's a price taker. And we had this weird outcome I showed you in the ticket market where if demand was low enough, teams would actually just give the tickets away, or the price would be zero, so that they could fill up as many seats as possible. Now, that's not how it plays out, because the ticket market isn't perfectly competitive, right? If I want to go to a Green Bay football game in terms of at Lambeau, there is only one person selling tickets to go to a Green Bay football game at Lambeau. There's no other substitute there, right? So we would say that these teams, even if it's not for every consumer, for a vast majority of consumers, they have monopoly power, right? If I'm, I don't know why I went with the Packers, right? But if I'm the Green Bay Packers, right, and I'm selling tickets to Lambeau, I'm the only producer. I'm the only one selling that product, okay? So we've got monopoly power from these teams, even if it's only for a subset of the consumer base, or even if it's only regional, right? Even if there were fans that they just want to go watch an NFL football game, if they live in, somewhere in this, well, let's say the Upper Peninsula, that way they're not near Chicago, right? If they want to go to an NFL game, the only feasible place for them to go is probably to Lambeau, right? Unless they want to add in additional costs like flights and traveling, all these things. So we would think that these teams have, at the very least, regional monopoly power, even if we assume that every NFL game to a consumer is the same. There's no fan loyalty or anything like that. So we've got this monopoly power. What's it going to look like in the ticket market, right? So one thing that we'll also kind of take a look at is also these leagues tend to have kind of monopoly power when it comes to selling the rights to games, like broadcast rights. Because if I'm CBS and I want to put on an NFL football game, the only person I can talk with to buy that is the NFL, right? So a lot of these sports leagues, right, they would also kind of think about them having monopoly power when it comes to selling broadcast rights or selling ad space to some, or not necessarily ad space, but selling, naming rights to their stadium, things like that. Okay. The government doesn't play as much of a role here, although at some point in this semester, we'll kind of review some of the court cases where it seems like the courts have kind of decided to say that sports leagues are a little bit different than other industries and have kind of punted on, no pun intended there, but punted on not kind of bringing these restrictions down on them, even though they have monopolized some of these markets. It's likely that a lot of these are more likely natural monopolies. We don't see a lot of cities that have two sports teams, right, in the same league. And the reason why is because quite often a city size only has high enough demand to support one team. If another team entered, both would have negative profits. One of the teams would end up leaving. There's only enough demand to support one team having zero or positive profits. If there was ever two teams in that city, there's not enough demand for both of them to kind of earn a positive or non-negative profit. Now, there are some cities where demand gets high enough to where there are no natural monopolies, right? You kind of think about cities like LA or New York tend to have two sports teams in these different leagues, and that's because there must be enough demand that they can support two teams. But a lot of the times, right, these smaller markets, we think about they kind of have natural monopoly power. If another NFL team tries to start in Indianapolis, neither team is probably going to be able to earn a positive profit there, right? They're splitting up a much smaller demand there. And maybe this is something like not just, we want to think about these products in terms of like just providing games. The quality matters, right? So if I'm thinking about, could I have two football teams exist in a city? Well, maybe if one was like a minor league, right, where they're producing really a different product, right? They're not trying to produce this high quality product, so they aren't going to have to spend near as much money. But if we're thinking about the exact same product, right, high quality, maybe in this instance, like high quality MMA fights, there's only enough kind of demand that supports kind of one major league there. Okay. So, when we think about a perfectly competitive market, we kind of thought about what's the equilibrium price and quantity. We look at where the aggregate demand and aggregate supply intersect, and we can identify that, right? Now, whatever price that would be, that's the price that firms are going to have to take, or these teams are going to have to take, or price takers, if it's a perfectly competitive market. But with a monopoly, they're setting the price. Okay. And so what is going to be the optimal price for a monopolist to set? Well, they're first going to look at what quantity, in terms of, here we'll kind of specifically talk about the ticket market in a second, but at what quantity of tickets would the marginal revenue of the last ticket be equal to the marginal cost? Because that's the point at which selling that ticket, I've now gotten to where I'm adding nothing to profits, right? The additional revenue is offset by the exact same amount of additional costs. There's no change in profit. That's where I'll stop. So if I continue to go even further, sell more tickets, my marginal revenue is only going to kind of decline there, right? And my marginal cost, if we have kind of a ticket market, is kind of constant across that x-axis. So, wouldn't make sense to kind of push past that point. And I'll give you a visual here in a second. So we know firms are going to choose wherever the optimal quantity, wherever marginal revenue is equal to marginal cost. Just like every day you make decisions, you do something as long as the marginal benefit is greater than or equal to the marginal cost to you. The marginal benefit here to the teams or the firms, marginal revenue. Okay. So we could go through a little bit of the mathematics here. If we think about, we've got a demand equation, and I won't ever make you kind of reproduce this, but this is giving you support. I don't know if you saw this in 201 or some of your other econ courses. But if we have linear demand, which I'll always keep our examples linear just to make the algebra a little bit easier and the math easier. We've got this linear demand curve, right? If I want to find total revenue, that's just the price of a good times the quantity I'm selling. So the price that I'm selling the ticket for times the number of tickets that I'm selling, right? That's total revenue. If I then substitute in to this price my demand equation, I'd have something that looks like this. Then if I take a derivative of this in respect to quantity, what I'm saying is, what quantity would I choose that would maximize this total revenue, right? So set a derivative, or sorry, set a derivative, take a derivative, set it equal to 0, and I could solve for the quantity that would maximize this total revenue equation. So I take a derivative of total revenue in respect to that thing I'm trying to choose, which is the quantity of tickets I sell, and I get that the optimal quantity would be set, or sorry, not the optimal quantity. The additional revenue that I'm generating here is going to be basically starting at the same point as my demand curve, but is going to have twice as steep of a slope. So this marginal revenue, the additional revenue that I'm going to be earning by selling one more ticket or an additional unit, it's going to look just like demand, but fall twice as steep. Right? The slope will be kind of whatever, we know that demand has a negative slope, so it'll still be downward sloping marginal revenue curve, but twice as steep as demand. Okay. So what that generally looks like is something like this. So we'll review it for like let's say this is an apparel market, right? We'll kind of think about what would monopoly power look like there, and then we'll move on to the ticket market. Okay. So here I've got, right, the profit maximizing point is always going to be where the additional revenue of the last unit sold is equal to the additional costs, right? For every quantity below that, notice if I sell this ticket, the additional revenue much greater than the additional cost, right? So I'm adding something to profit there, right? I'm adding more revenue than I'm increasing my costs. And that continues for every quantity up to where those two things are equal to each other, right? Where the additional revenue is exactly equal to the additional costs. So that's the optimal quantity of whatever apparel we're looking at to sell here for the team. What price should they set? Well, they know that the demand curve tells them the additional benefits to consumers, right? And let me see here. I'm going to switch over to this camera real quick, just to write some things down that aren't in the slides here. Second. Oh. Okay. So, if we think about demand is telling us the marginal benefit of each one of these quantities to the consumer, we know that consumers would be willing to pay as long as that benefit is greater than or equal to the price. So if I have complete power in this market, I'm going to want to try to set the price exactly equal to that consumer's marginal benefit, because I know they'll pay that, or at least that they'll be indifferent at that point, right? So if I think about what this means visually, my demand curve represents marginal benefit. Once I've identified the optimal quantity, I just go up to the demand curve, and it tells me that at that quantity, this is how much consumers benefit from that, addition, right at that optimal quantity. So I just go up to, oops, oh geez. Glad you guys didn't see that. My screen just freaked out. So I'll try going back here and see if this works. I think maybe it's because I didn't switch it over yet. All right, there we go. All right, let's hopefully it does. Okay, that won't continue, hopefully. So at that quantity, we just go up to the demand curve, and that's the price we know that we can get away with charging consumers, right? Because everybody who's purchasing tickets here, their marginal benefit is greater than that price. So everyone here is going to purchase tickets all the way down to this last person where they purchase the last kind of ticket, which was the optimal number of tickets for the firm to sell. So the kind of firm would first determine the optimal quantity, and then based off that quantity, look at their estimates of the demand curve and try to charge a price that would be exactly on that demand curve, right, at that quantity. Okay. Is this looking familiar? I'm kind of remembering this. Any questions up to this point? Because now we'll take a look at what it looks like in the ticket market, right? So I've got a visual here, but I want to kind of walk through a couple different scenarios. So if you have the slides, you can always go back and use that as a reference. But I want to go through and kind of build this out. So let's say we've got this ticket market, right? And we know that supply really runs along the x-axis and then is vertical at whatever capacity is. And then whatever my stadium is, like that's my capacity, right? So maybe 30,000 or 25, whatever it is. Let's say the demand is high enough such that when marginal revenue is twice as steep, And I may not be drawing this perfectly to scale, but I'm always going to draw marginal revenue as a steeper curve, right? I don't know, if I did the actual spacing, maybe this isn't quite twice as steep, but it should be, right? And it should start at that same intercept, right? Whatever our intercept value is. So here, if we choose the optimal quantity where marginal revenue is equal to marginal cost, well, remember, my supply curve, right, represents my marginal cost. Well, for tickets, it was all fixed costs. Once I build the stadium, it doesn't cost me any additional money to sell one more ticket. The seats are already there, right? So here's my marginal cost curve where it runs along the x-axis and then kind of goes up here at whatever capacity is at. So think about here, we've got quantity of tickets, and we're thinking about price here on my y-axis, what kind of dollars. So marginal cost is actually equal to marginal revenue right here, right? Because this supply curve represents marginal costs. So the optimal quantity, we'll call this scenario 1. Maybe I should put demand 1 and marginal revenue 1. So I'm going to draw something else in this graph as well. So I've chosen the optimal quantity, but I know that I can get away with going up to the demand curve and charging consumers whatever their marginal benefit is at that quantity. And so I've got the optimal price for my ticket I could set would be up there. And you can think about, if we saw shifts in demand that would increase the price, but potentially not change the equilibrium quantity. We went over kind of examples like that without monopoly power in the market, thinking about, I can only ever sell whatever my capacity is, okay? In the short run. In the long run, right, I might be able to renovate my stadium, build a completely new stadium, but in the short run, I've got a fixed number of seats, okay? So what if we had demand that was quite a bit lower, right? So who am I going to pick on now? What's a team that you watch and you're see the Tampa Bay, they were just the Rays now in baseball. If you watch a Tampa Bay Rays game, there is a 99% chance that the stadium is very empty. Have you ever seen that? A lot of the times, like, there's just no one at the games. First of all, it's beautiful. There's a lot of other substitutes. You can be doing something else, right, in Tampa, as opposed to being in a baseball stadium when it's 99 with 99% humidity, right? So let's say that for whatever reason, they face quite a bit lower demand curve here, which would mean they also face, right, a lower marginal revenue curve, okay? So here, where does marginal cost equal marginal revenue? Remember, marginal cost is just this supply curve, which runs along the x-axis. So marginal cost equal marginal revenue down here. That's going to be the optimal quantity of tickets to sell. Right? And then they go up to their demand curve, and their optimal price would be something like that. Now, it's kind of interesting about this, and we haven't really introduced the idea of different types of revenue, but ticket revenue is going to be one of the main ones. And we said for different leagues, this is a larger slice of the pie. When you think about NFL, we have 16 games. My guess is ticket revenue there, if we looked at the numbers, is a much smaller percent as opposed to ticket revenue for Major League Baseball, which has 162 games, right? Just a factor of 10 times more games. It's just a lot more revenue to be made there, even if prices aren't quite as high. So what these teams are kind of doing with their monopoly power is, they're not filling the stadium out near as much as they could. If they sold these tickets for $0, they could almost get close to filling up the stadium, right? Or kind of coming close to capacity. But right, if I sell my tickets for $0, I'm not making any profit there, right? But you can imagine maybe there's some trade-offs, and this become really complicated. So what might be a benefit? Maybe if I'm looking at this and I say, okay, if I'm only maximizing my profits, I'm only maximizing profits in the ticket market, then this is the optimal price and quantity. But if I'm trying to maximize overall profits, what could maybe an argument be for why I should try to lower the price a little bit and kind of subsequently increase the number of tickets I sell as well? Yeah.
You could make money through other ways like concession.
Yeah, right. Maybe if I just get people in, I know that I can make more money off concessions per attendee than I could the ticket price, right? Like, let's say I'm selling tickets for $20 and I reduce them to 10. But I know that those additional people that I've added, even though they're paying $10 less for a ticket, I know on average they spend about $20 on concession, right? So there are going to be some trade-offs here. Now we're solely talking about maximizing profits in the ticket market, right? If these markets are kind of joined by something, it gets a lot harder, right? Also, maybe what might be another benefit of having more people in my stadium? What's something else that a team could sell to make money? Yeah.
Oh, well, as far as the tickets, if they're lower at a lower price, say they would, you might get some new fans in there. That might be.
Yeah, potentially this is not just a static issue, not just today, right? But it's dynamic. It's the next 50 years, right? So there could be some dynamic issues. We could complicate this model as well. We're not going to do that because it kind of probably takes a level of math we might need that is a little bit outside of the prerequisites for this. And then there's one more I can think about. So those are both two good ones. There's one more I have in mind about why it might be better to have a full stadium. Apparel sales, anything in the stadium, right, that I can sell, that definitely could be beneficial to lower this price. The other ones I would think about is if you go to a stadium, what are there a lot of? Especially like if you look at like the scoreboard, around the scoreboard is always sponsored by someone, Pepsi, or choose your company. Well, if I get more people in the stadium, selling those rights for advertisements in the stadium have a lot more value to the companies that are buying them, right? Because there's just more people in the stadium. Potentially selling the broadcast rights to game, right? It looks better when there's a full stadium. And so maybe people that, broadcast companies aren't going to be as likely to want to purchase for as high of a price a game that looks bad when it's on TV where the stadium's empty. Right? So there's all these kind of different kind of complementarities between these revenue streams, but we're just thinking about maximizing revenue in a ticket market. This is what it's going to look like. And this is probably really beneficial for a more broad scope of sports because, there's a lot of like smaller sports, especially college level sports where you're not selling broadcast rights to, college bowling or something like that. Maybe there are, I don't know. But there's a lot of high school, college sports, amateur sports where really their main revenue source is ticket revenue, right? And so that's really what they're focused on is maximizing that ticket revenue. Okay. Any questions here before we keep moving? All right. So, like I said, here's kind of a reference just with some arbitrary numbers here. We kind of work through an example. And now we can start to think about if we were to look within the same organization or maybe same league here, and we can think about shifts in that demand curve. What's going to happen if demand is significantly lower for one game? All right, then the optimal kind of ticket price is going to do what? If I can get this to be back up here. We look here, right? What if the demand was lower for one game? We're going to see a much lower price, right? So anything that's kind of shifting demand is going to operate kind of similar to what it would in any market, not just a ticket market. So demand would be lower. We would see that the ticket prices would be lower as well as we would sell fewer number of tickets, right? We kind of already could see that. But one thing I haven't really done is what happens if we expand the size of our stadium, right? So here, I'm going to redraw this, and then we can think about what happens if we change the size of our stadium. And this is something maybe we could do in the long run. Right? So let's say, I don't know, we've got a stadium and the current capacity is right here. I don't want to do this. So here's our demand curve. And here's our marginal revenue curve. Okay. Currently, the optimal quantity is where marginal revenue is equal to marginal cost. Remember, this is our supply curve representing marginal cost, which becomes vertical at our stadium's capacity. Okay. We then go up to the demand curve at that optimal quantity. And here's the equilibrium price we would set. So what would happen if I'm able to expand the capacity of my stadium? So let's say somewhere out, actually, let me think. call this S2. Let's say my capacity is somewhere out here, right? This is where it gets a little tricky. It is a little bit different than kind of the shift or the difference in demand that I was showing you earlier. Where would my optimal quantity be here? Remember, my new supply curve runs along my x-axis and then is vertical at wherever my new capacity is. So marginal cost would actually be equal to marginal revenue right here. Okay. At that quantity, I then go up to my demand curve, and I can see that if I increase my stadium's capacity, I'm going to sell more tickets, but a slightly lower optimal price there. Right? Now, why I chose to do this, right? I would have to believe that whatever this price and quantity combination was, it should be greater than this price quantity combination in terms of profits. Otherwise, why did I build this larger stadium? Right? I spent all this money on it. Hopefully, the kind of change in profits from having that larger capacity stadium was more than enough to offset my costs. Right? But here we're just trying to understand what would the changes be to the equilibrium price and quantity if we had a change in stadium capacity. Okay? And there it would probably depend on where we're at in terms of the elasticity of the demand curve and things like that. So this could get like real complicated when it comes to long-term choosing an optimal capacity. We won't dive into that issue here, but right, we just want to understand what would the changes be in the equilibrium price and quantity for our ticket market if we were to change capacity. Okay. And that's like a little bit different than probably some models that we've seen before, right? We've got this weird kind of vertical, like L-shaped, well, reversed L-shaped kind of supply curve, and what happens if we kind of change capacity? It's going to shift that supply curve outward. Okay. Any questions there? I won't go through it, but you can imagine like what if stadium capacity got smaller, we could kind of do a very similar thing there. All right. So we get this shift out of the supply curve. I kind of show you what that looks like visually. We would expect prices to fall, but we would sell a high number of tickets. Maybe we don't get to the new stadium's capacity, right? In the example that I drew for you, right? We did sell more tickets, but we now have empty seats, right? So it probably didn't make a whole lot of sense to build that much larger of a stadium unless I think there's going to be changes to demand in the future, right? Otherwise, it would have made a little more sense probably just to renovate and make it a slightly larger stadium there. Okay. All right, so we've got kind of quite a bit of this ticket market down. So what would happen in this ticket market if they restructured top players' contracts and they instead kind of expected salary costs to increase there, right? Well, I'm thinking about kind of how much money I'm spending on my team. How is this going to impact the ticket market? Those are fixed costs, right? I've already paid those salaries, so there's really going to be no change. So anything that I can think about that would change the cost for the teams, it would have to be something that changes the cost to providing those seats or those tickets. And all of my other costs, right, they're independent of the number of tickets I sell. Doesn't matter if I sell 100 or 200 tickets, I still have to pay my players whatever their salary says. I still have to pay, property taxes on wherever the stadium's at, regardless of how many tickets I sell. Okay. So any other thing that would kind of change costs to the team, it's not changing the cost of providing the actual tickets, right? And so that wouldn't shift my supply curve for tickets at all, and we would see no change from something like that. Okay. So just want to make sure I kind of mention that here, where we see these other costs might change, but they're not tied to the number of tickets sold, so it's not going to impact my ticket market at all. Okay. We already went through that. I must have put another one. Okay, well, we'll start going through this here. I don't know if we'll have time to get through all of it today, but we can at least kind of introduce it. Yeah. So you've got these ticket markets, and we'll eventually start to break down other types of revenue. But before we do that, because one of the types of revenue is tied to what the optimal thing for teams to do in terms of the number of wins is, right? So what's the optimal number of wins in order to maximize profits? Okay. And are firms or are teams here really trying to maximize profits, or are they trying to maximize wins, right? So there's an optimal number of wins to maximize profits. And then there's just optimizing the number of wins. I don't care about profits, right? I'll drive my profits down to zero as long as I can win more games. So there's two very different kind of objective functions for these teams. So traditionally, I don't know, what other course might you have seen something like maybe revenue maximization instead of profit maximization? Well, I think IO is currently going right now, so it's a new class. So that you would, yeah. So you would go through something like that in like and I say IO, sorry, industrial organization class. You would start to think about firms that might not want to be maximizing profits, but traditionally that's how we think about it. Anytime we talk about firms are maximizing profits, right? So what if instead they wanted to maximize wins? How could we determine kind of the difference in those two points? Okay. So to start out, we'll have, I think I've already alluded to this, but if I'm trying to optimize profits versus optimize the number of wins, why is there a trade-off there? Well, because I can always go out and spend more money and try to get higher quality players, but right, the additional number of wins that I get may not bring in as much revenue as it costs me to spend on those players, right? And so potentially there's a trade-off there, right? I can actually make more profit by winning slightly fewer, like as long as I'm still a pretty high quality team, even if I'm not, the top quality, even if I'm third or fourth, I might be able to maximize profits by winning a small number of games, because if I want to be the number one team in the league, win a few more games, I'm gonna have to spend a lot of money, right? We kind of talked about the marginal cost of a win is increasing, right? If you think about in the NFL, like if I'm winning 12 or 13 games, to win all 17 now, I mean, I'm going to have to spend a lot of money to really get this high quality team, because it's just very improbable that I'll even be able to win 17 games, even if I have the highest quality, right? So I'm going to spend a lot of money. So there's this trade-off that exists. And we can think about, how do we identify the optimal number of wins? Well, if we think about wins, we'll say that every win that I want to target has a certain cost associated with it. So there is some cost function that is increasing with the number of wins. If I want to win more games, I'm going to have to spend more money, whether this is on facilities, player talent, et cetera, right? We know that there's going to be some cost function, and it's kind of, if I took a derivative in respect to the number of wins, it would be positive, right? To win more games, I'm going to have to spend more money or increase my costs. We also know that revenue is likely increasing with the number of wins that I get as well, right? The higher quality team I have, the more apparel I can sell, the more tickets I can sell, right? So these two things are both kind of increasing with the number of wins that I'm targeting. So my profits will really just be the difference between the two, okay? Now, we'll simplify the model a little bit here, thinking about if I'm trying to maximize profits, we'll simplify these costs. We'll just assume for a second that wins, like the cost to a win, is constant here, right? It's not an applicable assumption. It makes the model just a little bit easier for us starting out. And then we can kind of build, okay, what would it actually look like if we had increasing costs? Right? So we'll kind of keep that marginal cost of win constant for right now, just some amount, right? If I want to win one more game, this is how much it's going to cost me, okay? Revenue, we can think about, we'll still keep as increasing with the number of wins, right? So if I want to kind of increase my revenue, right? I increase number of wins, so it's going to increase revenue, but it's doing so at a decreasing rate. So my marginal revenue is still going to be decreasing, right? So kind of think about if I'm, the additional revenue earned going from 70 to 80 games will be a lot more than if I'm going from 95 to 105 games. And I kind of was thinking about Major League Baseball here, right? So this kind of makes me like at least a competitive team. Here I was already very good, so winning an additional 10 games really didn't generate that much more additional fan demand, okay? So we have marginal revenue is still declining, but it's positive, right? If I win more games, revenue still does increase, just doing so at a lower rate, okay? So we can kind of think about what's the optimal number of wins. Well, just like in any other market, if I'm choosing the optimal quantity, like with the ticket market, It's where the marginal revenue of the last ticket sold is equal to the marginal cost. So for wins, the optimal number of wins to profit maximize is where is the additional revenue from that win equal to the additional costs, okay? So here, I'm going to set this model up. Like I said, we've simplified with this assumption that the cost of win is constant, but we'll kind of change that probably on Thursday. We'll take a look at that. So here, I'm thinking about now the quantity that I'm trying to choose is the optimal quantity of wins. And I think I mentioned this last time we met, that whenever we're talking about like the targeted number of wins, it's not, you know, that they're guaranteed they're going to win 7 or 8 games if they target it, but it's the expected number, right? Based off their expenditures, this is the expected number of wins that the team can, you know, the number of wins the team can expect, right? So this is all, you know, decisions made before the games are played. So let's say we've got, kind of think about our y-axis is kind of representing dollars here. And I said, we're going to simplify and say, we've got this constant marginal cost, okay? So we've got this constant marginal cost, and think about here, there is an overall demand curve for the number of wins from any one given team, right? And then very similarly to the ticket market, we're going to have this marginal revenue curve, right? Marginal revenue of these wins, which is twice as steep. So the optimal quantity is going to be where the marginal revenue of a win is exactly equal to the marginal cost. So if I'm profit maximizing, the number of wins is just going to be where that marginal revenue curve hits that marginal cost. Okay. I'm not thinking about necessarily like charging a price for these games, so the demand curve becomes, I guess, a little bit irrelevant here. But we kind of think about there is an overall demand for kind of quality from these teams, right? So the marginal revenue for each win is really coming from whatever that overall demand is. Okay. Now, this would be where I'm profit maximizing. This should be the number of wins that, or expected number of wins I'm targeting. Okay. What if I want to win maximize? So if I want to win maximize, right? I want to win a higher number of games. So I'm going to spend some additional money. I'm going to increase the number of wins by spending more money. Now the additional cost is constant. I'm still adding to my cost, right? It's just, this is the marginal cost. How much is being added to my total? Okay. And what's going to end up being true is as I spend more money, right? I can spend up to the point where the demand curve is equal to the additional marginal cost. Now, this works because I've kept marginal cost constant, that at this point, this is where we'll call the optimal number of wins if I'm win maximizing. And this is going to be actually where profits are equal to 0. As long as I have a constant marginal cost and a linear demand, so we could back this out if we really wanted to. Think about here. So if I've got price times quantity minus marginal cost times quantity. So this would represent my profit. So here I've got total revenue, and here, because marginal cost is constant, this represents my total costs. And here, quantity is actually my number of wins, right? Okay. So if I rewrite this, where is this going to be 0? Where it's where price is equal to the marginal cost. And remember our demand equation. Looks something like, well, here, sorry, not Q, but W. So that's the point, right? Where my demand curve is equal to marginal cost. That's where profit is equal to 0. That's only because I kept marginal cost constant. That's why I did that, to simplify the model a little bit so that we can easily identify, well, really, if I'm win maximizing, let's say my costs are 0. Like to adding player talent. If I'm win maximizing, I'm just going to accumulate as many, or I'm just going to continue to try to win as many games until I've won every single game, right? So because there are actually costs, well, I can't just continue to add players, at some point, my profits are going to go negative. And just like any other market, we say in the long run, if profits are negative, what would happen? In the general market, if profits are negative, that firm, in the long run, they leave the market. Same idea here. If teams were spending past this point to where their profits were negative, right? At some point, that team would have to leave the market, right? It's not sustainable. Unless, I guess, the one caveat here would be if you had like some billionaire owner who's taking money from another market to spend here, right? But it, I don't think there's probably some of that going on, but I don't think to the extent to which they are just losing money continually for decades. Right? Like you can imagine, I could build a more complicated model that's not just one snapshot in time, but over time, maybe I have negative profits for 2 or 3 years, and then go back to kind of more of a profit maximizing model for 5 years to kind of build up my reserves so that I can have these like small periods of time where I'm successful, and then these other periods of time where I'm not as successful, but I'm maximizing profits, right? I'm building up to have money to spend in the future. We can kind of see here, the difference would be that obviously a win maximizing team is going to target a higher number of wins, even facing the same demand curve, right? So even facing the same demand curve, that win maximizing team chooses a higher number of wins, and they stop at that point where profits are equal to 0. Unless we want to make it a dynamic model where it goes across 20, 30 years, and just complicate it a little bit. But these principles would still be there. Okay. Any questions on that? We'll keep moving here. All right. So I'm going to try to go through a couple things here. So let's say, I'll redraw this graph because I don't think I can do this all on the same thing. So drew a little bit too big there. Let's start to think about differences between large and small markets. Okay. So let's for now assume that both large market teams and small market teams face the exact same marginal cost to win, right? Right. If they want to say add the same player, it's going to cost them the same amount of money. But we'll just assume that for a second. I'll probably introduce an idea before we leave today, or maybe that's not the case, but let's just assume it is, and then we'll kind of go from there and maybe add in some additional wrinkles. So let's say marginal costs are the same between the two, but what we know is that the demand that a small market team faces is going to be lower than a large market, right? In the sense that, right, they have a higher, these larger markets we think of as a higher number of people, so a higher number of consumers shifts demand out, more income, right? Normal good, that would also shift demand out. So large market teams face a much higher demand curve when it comes to choosing the optimal number of wins for their team. So here I can identify the win maximizing points right away, right? So points where profits are 0 for a small market team. So we'll call this the optimal wins for a small market team if they're win maximizing. And here would be the optimal number of wins for a large market team if they were win maximizing. Now, what if we had, and I'll draw this one way, it may not end up looking exactly like that, and I probably shouldn't have done this. So let's say, here's my marginal revenue curve, right, for large market teams. And here's my marginal revenue curve for small market teams. Where would my profit maximizing points be? Well, profit maximizing is where marginal cost is equal to marginal revenue. So here, for a small market team, there's the profit maximizing number of wins. Probably should have given myself a little more room here. And then for large market teams, our optimal number of wins would be somewhere like right here. So you can see it kind of depends. Like, it depends on the behavior of both teams. Now, if they're both profit maximizing, you can see the large market team's going to have a higher number of wins. They're both win maximizing. Large market team would have a higher number of target or expected wins. But if there's kind of a different combination, so let's say that large market teams tend to be greedy. I don't know if this is the case. I'm just building a story here. And they are profit maximizing. So we know they're going to be targeting this number of wins. But these small market teams, potentially they're like new owners. It's like new money. They've got a lot of money. And they say, look, I'm going to, spend as much as I can up to the point where profits are zero, and we're going to win maximize. Well, then you could see a scenario where the small market team actually has a higher number of expected wins than the large market that's profit maximizing. Right? And there's other combinations that we could compare the scenarios as well, right? It's not like these are all going to happen at the same time. Like some small market teams might be profit maximizing. Some small market teams might be win maximizing, right? And that's why you can see some small markets actually end up with a higher number of wins than larger market teams, because there's likely a lot of this different optimization going on in the background. Some large market teams will profit maximize, some will win maximize. Some small market teams will profit maximize, others will win maximize. And it'll change year to year, right? Like I said, there's probably cycles. It's most likely that some of these teams profit maximize for a few years and then try to win maximize, right? Because it gives them a higher, higher store or reserves of money to spend until profits are zero those years. And it could be if demand was out. I tried to draw some pretty large differences in demand here, but you can imagine every team, it's not like it's a binary large or small market. It's a continuum, right? So you could draw every team's demand curve in here. And the sad thing is potentially for some teams, let's say these were even further out, right? There could be a scenario where this marginal revenue for the large market team, even if they're profit maximizing, is always going to be a higher number of expected wins, even than these small market teams that are win maximized, right? You can imagine if it was just shifted a little bit more to the right there, even if the large market profit maximizes, they still will have a higher number of expected wins than the small market teams. So this might be true for something like if you're comparing teams in New York to a team in, isn't there a hockey team in Columbus? Am I making that up? Yeah, okay. I'm not making it up, right? No, okay, all right. Well, I always say that, and then I'm like, there's no way there's a team. But yeah, so Columbus, I'm guessing, doesn't have the market size probably to, even if they're win maximizing, it'd be very difficult for them to get a higher number of expected wins than maybe a team in New York, right? And obviously there's like user errors or whatever. When it plays out, maybe they do, but there would be some significant differences in demand curves for a market as small as Columbus versus a market as large as New York, right? Any questions on this before we keep moving here? All right. One thing I've been thinking about, and I'm going to draw this separately because I think it'll be too much for one graph. But let's say we had two cities of the same size. And you could argue, I could have drawn this in here because it is probably a small, large market issue. But I think it's better to think about it as two markets of the exact same size. So they've got some demand curve. So I'm going to say LA, and I'm going to choose Houston. I'll try to build my story here. They probably wouldn't be the same demand, right? But maybe, let's say it's for football, and maybe Texas demand is a little bit higher. So even though LA is a slightly larger market, right, they don't have as many consumers interested in the NFL. And so we'll kind of say that the demand is comparable, right? They're in like a very similar kind of market size. Houston's a huge city, right? So they are a large market, but we'll assume the demand they face is the same market size. So we've got kind of the marginal revenue here, right, is going to be the same for both, right? We could do marginal revenue for LA and marginal revenue for Houston. And let's say I'm going to do Houston up here. So let's say here's the marginal cost to winning additional games for Houston. And let's just for now assume that everyone's profit maximizing to make our life a little easier, right? So we've got for Houston, here's their profit maximizing number of wins. What do you think some players might do when it comes to choosing a team to play for? What might they do when going to LA that they wouldn't do going to other large markets? What opportunities might exist in LA that don't exist in other large markets like Houston? If I'm LeBron and I want to be in Space Jam 2, right? I have other areas I can make revenue by being in LA, right? So what might I do when looking at the salary or the contract offerings from multiple teams? I might look at LA and say, it's a little bit lower, but I know I can be in Space Jam 2. I know there's a lot more opportunities for me to do deals with different brands, right? That's where a lot of people who I would want to collaborate with to do these other things outside of basketball exist. And so maybe LA is attractive and those players would be a little bit more likely to take lower salaries. And this would probably be the true for small versus large market, right? It's better to be a player in terms of your own financial interest to be in New York, Chicago, LA, as opposed to Indianapolis, to be quite frank, right? Like there's just not near as many opportunities. So if they'd be willing to take a lower salary, potentially, right? The teams in LA, to win an additional game, they actually can do that at a lower cost because they can get the same players like at a discounted rate. So potentially, if we think about these differences between like LA and Houston, maybe LA actually faces lower marginal cost, right, to winning additional games. This is how we would model that. And I would argue if you look at, it's hard because you can't ever look at like LeBron in the same year. He only signs one contract. So you don't have a comparable, but you could look at the offerings and you can see that a lot of these players to get into large markets will take slightly lower amounts, even if there were higher offers out there, right? And that's because of the additional revenue they can make outside of just their salary there. And so if that's the case, what would the profit maximizing point for LA be at? And this is where I shouldn't have wrote Houston quite as large as I did, right? You can see that if they, for some reason, players were giving teams in certain locations a discount, right? That they would actually have a higher number of expected wins, even if the behaviors are the same, right? If they're both profit maximizing or they're both win maximizing. So, I don't know, an interesting thing to think about that I haven't really necessarily seen modeled a lot when it comes to this discussion of large versus small markets, because I chose LA and Houston here, so we had two markets of comparable size. It's very possible that we have this going on for large versus small markets, while at the same time, we have the demand differences as well, right? Which would just kind of, it's like it's two ways that in which these large markets are going to be benefiting, or at least we would expect them to have a higher number of expected wins. Okay. Does that make sense? Any questions over any of that? No questions? All right. So let me see here. We drew this out. So here's another way of thinking about this. I don't we won't use this very much. But here, if we had kind of a traditional, and this was actually, I just pulled this graphic because I like this, but we have kind of a typical kind of assume that marginal cost is constant. And we're thinking about profit versus win maximizing number of wins. You can also think about that as if I were to graph out my total costs and total revenues. I said they're both increasing with the number of wins. So you can see here, total costs are increasing with the number of wins I want. And so are total revenues. It's just total revenues are increasing at a decreasing rate, right? And so if we were to draw out the marginal revenues and the marginal costs, it would look something like that. You can imagine here, if I'm choosing the optimal number of wins, the greatest gap in between total revenue and total cost is going to represent where profits are maximized. So you can kind of see visually here, that would be like right here, right? Wherever that gap between total revenue and total cost is the largest, that would translate to the profit maximizing number of wins. And then this point where total revenue is equal to total cost. Well, if total revenue is equal to total cost, profits would be 0. That represents the win maximizing number of wins. Okay. So we kind of worked through some different models, talked about differences here. I don't think I have anything more. Revenues, costs, wins. All right, it was just me drawing all the graphs out. Yeah, so now I thought that's where I wanted to stop. So next class, we'll start to talk about all these different sources of revenue. Okay, so we've talked about ticket revenue, right? But I've also kind of mentioned some other ones, right? Broadcasting rights, licensing income for apparel, things like that. We'll look specifically at Thursday. I'll post up another article. We'll look at it's an article about naming rights, like selling the rights to the naming rights to the stadium. It's a huge source of revenue. And then we'll also kind of introduce the idea Thursday about league transfers, right? So there's some of these things where the leagues have identified the issue of large markets are at an advantage, right? We'll talk about later on, one thing that we know fans like is competitive balance. So they like games where they don't know the outcome going in, right? I don't want to go watch, Alabama play West Texas A&M because I already know the outcome of the game, right? But so what they just, they realize, well, large markets are always going to have an advantage. They have, higher demand curve. So what can we do? We can do some revenue sharing, right? Or some league transfers. So we'll talk about that a little bit as well. I think we'll get there on Thursday. If we don't have quite enough time Thursday, we'll definitely talk about league transfers next Tuesday. It's actually, I believe, the last question on the homework, which I'll post after class today. I think I said last week I was going to post it Thursday. We didn't have class, so I'll hold it off until today. You should be able to work through probably the first 4 questions, I think, after today, maybe 3, maybe not completely the 4th question, but at least the first 3, right? And then after Thursday and next Tuesday, you should have enough. And that due date will be 2 weeks from today. So you have quite a bit of time to work on that. I would suggest working on it now, though, kind of get through the questions that we've already covered the material on. Like I said, the first 3 or 4. And then as we kind of move through material at each additional class, you can kind of chip away a little bit more and more at that homework. Okay. So this is what's coming. But we've talked a lot about ticket revenue. We'll talk more about kind of the specifics across different leagues next class. But I do want to get a little bit, and which one was this? So I need to make sure that this is the one I want to start out with. So there's 2 files up there on Canvas. So if we go to files, there's this course readings folder, and I'll probably throw these in another folder after today's class and call them like week 2. And then I'll put up the other paper for next Thursday, or Thursday's class, and call that like week 3 reading or something like that. So I've got them open here. So the first one we're going to take a look at is not that one. I wanted to do, yeah, this is the one I want. So it's beer sales and attendance, and then it had the 2 next to it. So that was the one that we're going to start out with. So I said, when I want you to go through these papers prior to class, really the one I want you to do is kind of focus on reading the abstract first, and then kind of skimming through the intro and conclusion, just to get an idea about what the paper is, right? And then we'll walk through a little bit more of the regression analysis of the paper in class, okay? So here, what they're really trying to get at, even from the title, we can kind of guess, they were looking at these mid-major universities, kind of older time period here. I haven't seen someone recreate this with newer data, because I know a lot more teams have started allowing alcohol sales. So it'd be interesting to see, that'd be a potential project idea, and you could follow a very similar kind of methodologies they do. But they were looking at these football teams that start to allow beer sales at the stadium. What happened to their attendance, right? And so they use some ordinary least squares, which is really basically just linear regression. So OLS is just another terminology for that. And they found no evidence that beer availability increased attendance or revenue, right? Which is kind of surprising to me. But we can kind of go through, we could read through the introduction to get an idea about what kind of spurred their interest. So I think here specifically, and they mentioned Bowling Green, West Virginia, some of these teams who have started to allow beer sales. And then what I typically do when I'm going through a paper, I read the abstract. Okay, interesting. They kind of give me what their findings are and the general question. Then kind of show down here. I always look at the tables. I don't read through the text, to be completely honest. I go down until I find a table. The table, if it's a good paper, should be self-contained. It should tell me some information. So here, this first table, okay, it lets me know like these are the kind of schools that started to allow beer sales in this time period. And these are going to be the schools that they're kind of identifying this effect off of, right? And then keep going down. I'm going to see, okay, some of the other variables they have, if I'm going to try to guess. So anytime we see this word lag, that always just means the year prior, right? So they have this variable in their data, which is from the previous year. And that makes a lot of sense sometimes. So for instance, here, they wanted to control for what was the team's win percentage the previous year, right? Now I can control for the team's win percentage in the current year that I'm looking at, but probably for the first few games, most of demand and ticket sales were probably driven off of the success from last year as well. So they've got both of those variables that they're probably going to use. They've got undergraduate enrollment. I'm going to guess that's what that is. And if you really want to in the paper, you can kind of see here, they've even kept all the variable names bolded so you can okay, attend is the attendance of, okay, so, you know, I can figure it out if there's one where the label isn't clear. Looks like beer here. I believe what this was, it was just a 1 if the team allowed beer sales in the stadium, 0 if not, okay? Then we've got other things, right? So I don't know why they created a specific indicator for Boise, but they did. They've got conferences. So was the team in the MAC or the WAC, right? A 1 if they were, 0 if not. They've got a stadium capacity measure. Looks like the average capacity in their data set was about 30,000. So, you know, these are some teams maybe from some smaller conferences. And then I keep going down, and usually what I look for, we're going to skip this table because I'm pretty sure, oh, did I skip it already? I might have skipped it when I was showing you the other tables. They should have oh, here, they don't give a specific equation. So a lot of the times what I like to see in a paper, I think that's in this one. Scroll down here because I know this one has one. I usually try to look for their regression equation, right? So it tells me what their dependent variable is and what their independent variables were. This one didn't do that. It did it in words. They tell me that, okay, up here is probably where they say it, right? Not explain it. The dependent variable is attendance, right? So instead of being nice and like typing out just one equation where I can quickly find it in the paper, this one actually kind of, you know, put it into paragraph form. But generally, I look for that equation to say, okay, what linear regression did they run? What was their dependent variable? Here, their dependent variable is attendance. And then the variable they're really interested in is this beer variable, right? So what they did was something like this. They're telling us that their dependent variable was attendance, right? I believe this is measured in as the number of people attending the game, right? So the units is like people, one person. They then said, okay, there's going to be some intercept, and I should write this out the way that they typically do in papers, which is using these betas for our coefficient. So beta 0 is our intercept. They then had this beer variable, and then they had like, you know, win percentage and all these other control variables on the right-hand side. So what they were really focusing on to answer their question about whether or not allowing beer sales increases attendance, right? I would look at this coefficient that's associated with beer sales, right? Now, because the beer sales, I don't believe, we'll double check in the paper here. I believe it wasn't continuous. It was just an indicator. So it was a 1-0 variable. Mentioned last time we met, the way we interpret these coefficients is a 1 unit change in the X variable predicts that the Y variable changes by whatever that slope coefficient is. Right? Well, if it's a 1-0 variable, a 1 unit change just means if I go from not allowing beer sales to allowing beer sales, here's the expected change in my attendance, and we would expect it to an increase, or it's positive. I mean, maybe not. Maybe it becomes, you know, not as family friendly, so not as many families attend the game, right? I've personal experience with going to games like that where if I had kids, I probably wouldn't want them to be around the drunk people around me. So that's really what they're trying to do. They're trying to basically figure out what that slope coefficient is on that beer variable. So we'll go back and let's just double check. We'll look for, yeah, so that's just beer availability. So just a 1-0 variable on whether or not they allowed beer sales in the stadium. We can kind of see that here in the descriptive statistics as well, right? The maximum is 1, the minimum is 0. This is just a binary variable, okay? So let's scroll down here and find the next table. Here we go, table 3. This would show me my regression results. And Thursday, I'll try to bring in a data set where I show you how we run these regressions in Excel, which is eventually what I'll expect you to do on your project, which I had a couple people reach out to me. I sent one data set out today and the other one's almost ready to go. So if you're starting to get ideas or you want to kick around some ideas, feel free to reach out. Want to try to get those kind of solidified the next 2.5 weeks. I think it's February 11th is the proposal deadline. So we look here and each one of these columns represents a different regression, okay? So this represents one regression, this represents another, and it's because I think that they did some different things, right? So they use an estimation called instrumental variable. We're not going to bring that up here today, so we're going to ignore columns 3 and 4, just because it's not something that if you've only taken 221, it would take a longer description to go into what that means. So we're just going to focus on their OLS or their linear, simple kind of multiple linear regression. So they included, all these control variables, and then they show you the coefficient associated with each one. Now, what's kind of annoying here is they didn't give us kind of the star. So I think last class I said, typically we show the significance, whether we can reject the null, which the null was that there's no relationship. So if we can reject it, what we're really saying is we found evidence there is. Well, there's no stars here, and they only really gave us, instead of p-values, they gave us test statistics. So for instance, like a test statistic of 5, that's going to be a p-value. This is probably, this is statistically significant. And a lot of the papers we'll look at, and this one, I just wanted to kind of introduce some things, and I thought it was pretty simple in terms of what they did. But most papers we look at, they would denote whether or not it was statistically significant with stars. Here, for whatever reason, they want you to do a little extra work and kind of use that test statistic and go look up the p-value. It's a little bit ridiculous. The editor let them get away with this, but some of the papers we will look at have flaws, right? So really what we want to focus on is the sign of this Beer coefficient. And we find that it's positive, but not statistically significant. And then here, when we include a control for what the capacity of the stadium is, we'll notice then it actually becomes negative, right? But still not statistically significant. So we can't say that the relationship between allowing beer sales and attendance is anything other than 0, right? Our p-values are way too high. We cannot reject that null, which the null is what we start out assuming is true, is that there's no relationship. We can't reject that. We can't say that there's any relationship between beer sales and attendance here. So that's how we'll kind of start working through these papers. I'll probably read the abstract and then go down, look at their tables, look at their estimation equation. If they don't have one, we'll kind of write it out. I'll show you what it was. We can then look at the regression results, and now we've kind of got our question answered. Okay. I don't think they have any, if I remember right, that was the last table here. Yeah, so they don't have any additional kind of results here. This is a pretty short, basic paper. Like I said, I'd be very interested to see. I mean, this is 2005 to 2012 data. I know there's a lot more teams since 2012 who have tried this switch. I also think that there's some teams that have went back to not. So it'd be interesting to build a little data set there, find the schools that do, and this college attendance data is out there. It's pretty easy to get, and you can kind of figure out, whether or not this actually is having an impact. One thing I would mention here too is we also want, when we'll go through these, we want to think about maybe some other potential shortcomings. So here, if I don't include things on the right-hand side that matter, so my additional control variables here, if I'm missing something that is a huge predictor of attendance, but was also correlated with the decision to make beer sales available, then potentially I've got what we call bias built into my coefficients. So, or the omitted variable bias. I have omitted variables from my regression that matter a lot. So one statistic we have that is kind of a good way to make sure we haven't left out too many important variables is to look at this R squared. So R squared tells us what proportion of the variation in attendance, or my Y variable, that I'm explaining with the variables I've included. So I'll say that again. R squared is telling us the proportion of the variation in our dependent or our Y variable that we are explaining with all of the X or the right-hand side variables we've included. So here, I could turn it into a percentage by just moving the decimal 2 places. So I'm explaining about 50%. So there's still half of the variation or half of the things that change attendance that I haven't accounted for. Now, when I include the stadium capacity, that rate increases quite a bit. And that makes sense, right? Capacity would be a very strong predictor of how many tickets I sell, right? And I'm up to like 72%, but there's still quite a bit that I don't have here. 72 is pretty good for an R squared, but there could still be things that I'm omitting that are biasing my results. So I don't know, what's maybe one thing we could think about? So they've got kind of the conference. I think they did Boise. I think if I remember right now, they did said something about it being a kind of a more in a heavy Mormon population. So beer sales, there could have be, some offsetting effects there. What's maybe something else we could include here? So what might be something that would change attendance at these universities, but also be correlated with kind of whether or not they had beer sales? Yeah, maybe the demographics, right? The gender breakdown of the school, of the city, right? There's some cities like North Dakota that are like 70% male because of different industries that have popped up. So we might want to control for that.
Necessarily when the game starts.
Yeah, right. For some of these teams, and they probably pick a little bit of that up with the conferences, but right, some of these teams are playing games at very different times, right? The MAC has games at a lot more night games than these larger conferences are primarily going to be kind of in your sweet spots, right? Like whatever time slots can make the most money, not a Wednesday, Wednesday 8 o'clock game like some of the MAC schools sometimes do. Yeah, we could account for the weather that each team plays in. I'm not sure that would be well. Maybe the warmer it is, the more beer, right? The more likely, the more money you can make with beer sales. So yeah, maybe there's some correlation there. So we always want to think about these things that we could add in, right? Or that could somewhat be influencing these results. And I'll likely one day take a little bit more time to explain exactly how we can actually put a sign to the bias, right? We'll hold off on that for now. Okay. So we didn't get through the second paper. It's all right. It was a similar idea. They just had a different dependent variable, which is instead of attendance, I think they were looking at like crime rates in whatever the city was that the team was located in. But I'll put that additional paper that we'll go through on Thursday about naming rights up there on Canvas once I get back to my office. I'll also post that first homework assignment and start thinking about some ideas for the project. Reach out to me. We kind of get some data sets together here early on. Okay. Any questions for me before we let you guys get out of here? All right. We'll see you on Thursday.